Good morning, ladies and gentlemen. Well, the risk dial, by my calculations, is around minus 70, so extremely bearish. But I think I'm going to ignore it this week, and I'm going to predict that we are at peak bearishness for all assets. I think bonds have reached their targets. Let's examine where they are and what is most likely to happen over the course of the next 2 or 3 weeks. Funnily enough, there was very little change in the yield curve over the course of the week. As you can see, what did we close? Another 3-4 basis points lower in the 2s, which is really not much of a change. The likelihood is that we will test lower in terms of yield curve if it goes flatter. But at some stage, this will turn around in a big way and start steepening. That will be our signal that the recession is actually starting. I think it's going to take a long while for that to happen because the Fed still needs to hike rates to where the market is discounting, and that is around the 4% terminal rate. So you can see how many meetings we have before that is achieved. But I really think that, when I really do think that it does go down and flattens into negative territory and predicts a recession. But we are so close to those levels that I'm not sure that it's worth playing, and I will show you later on in the outrights, in the individual tenures, why I think that is the case. I think the yield curve now becomes a signaling method rather than something that we need to trade. We need to look at the yield curve to get the signal for when to get on board the individual tenures. That is what I really mean. The weekly 5s/30s, just like the 2s/10s, what did it move? 1 basis point here? That's nothing. I still think that at some stage we break higher, but I think over the course of the next couple of weeks, it's not really going to be dramatic. These are now going to be parallel shifts. And if we look at what the actual individual tenures are saying and what their objectives now are, I think you'll understand why. And here we have the 5-year note. Absolutely top ticked it. And what do I think happens now? I think that basically if we go back in time, we will see what is most likely to happen, and that is one of these kind of trading ranges back down to 308 to 299. But you can see how many weeks, this is a weekly chart, so you can see how many weeks that is. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So basically we're talking about the end of the summer, that kind of a range. Now, why would that be? Well, we can understand why the top side would keep on trading, and the top side keeps on trading because inflation is doing what it is doing, and how things are where they are. Inflation is not going to turn around on a tuppenny bit. It's going to take a very long time for the market to conclude that the inflationary period is over and that now inflation is going to decelerate. But also we have reached, the levels at which the market has to start discounting that in 2023, at some stage, you actually do get some Fed rate cuts after the huge run up to 4% or even 4.25% in Fed funds rates, and then the curve starts going negative, expecting cuts, probably for the latter part of 2023. in which case I would have thought that a trade between 358 or 359 and all the way down to just below 3% is the warranted first reaction of the market. We have reached every objective, okay? Every objective has been reached. Being bearish bonds here, to me, is for the birds. It's for the people who have missed this whole move, and that's not been us. So I would have thought that a reasonable target for fives would be back down to 308 to 3% over the course of the next couple of weeks. 10-year notes, and here is my nightmare scenario line, and where did the market close? Right on top of it. That's because these levels matter, and now we will basically trade 3% and lower is my guess. Look what happened here. 1, 2, 3, 4, 5, 6 weeks of it. We could easily get 6 weeks of trading just above and just below 3%. Why not? As I said earlier, I think the market will probably trade with a completely flat yield curve with everything around the 3% area. What do you want to do? Whether that is 5s, 10s or 30s. That would not surprise me in the slightest. I really can't see any, unless commodities accelerate, and we'll have a look at those later, I really can't see any reason why the bond market would want to do more on the upside in terms of yields. I think now it's going to basically try and screw everyone who is long of yield and short of prices, and that means backing and filling, doing something like this, and which takes many, many weeks. I don't think it's going to go that far to the downside. I would be shocked if we broke this line. I mean, absolutely shocked. This is 273. It's not going to happen. Therefore, a lower level of volatility in bonds is more likely than not. A lower level of volatility means slightly higher prices, and that means trading around this 3% area for a long time, probably the whole of this summer. Third is almost top ticked TLT. What does that mean for us? I mean, it just basically is the same chart in all of them, isn't it? Back down towards this 3% area, something like this or something like that. But you can see how many weeks it takes going sideways once it's reached certain targets. This is almost the perfect hanging man doji, which basically says that we are going back down to here, which is 3%. I see absolutely no reason to be bearish of bonds at the moment, bond prices. I think that the likelier path is back down to 3% in every single tenure of the curve, or basically the trading around between whatever levels we have seen this week and not exceeding them for a very, very long time. To me, selling volatility in bonds or buying bonds is not going to be a problematic trade for a while. Look how many weekly bars we trade at these levels, consolidate, wait. This makes sense. It's going to take a long time for the market to make its next significant move. I feel a lot better calling a top in bond yields in the States if I can see the prospect of a top in bond yields in the EU as well. This is the Schatz. I mean, my levels are pretty damn good, but this is ridiculous. It closed right at my target level around the 109 level. This is a weekly chart. If we turn this to a monthly chart, you can basically see where we are. It took many months of trading sideways. I'm sorry about this. What have I done? Here we are. It took many months of trading sideways for us to make the next move. It would make some sense to me to get some, backing and filling in this chart. If we return that to a weekly chart, we can see that, we've had the move. If we have a look and decide that this was the bottom and that was the top, where is the retracement? Say something like a 50% retracement. We are looking for around this, what's that, 68 yield. Would that not make a lot of sense? It's unlikely that we get acceleration in inflation, and therefore some backing and filling back down to 68. And trading between here and 68 makes far more sense to me than anything else. All my targets have been achieved and exceeded in certain cases. Therefore, I really cannot see why we would have a continuation leg higher in yield. What is going to come out that is going to give us that impulse? We already know about inflation. We already know 99% of what there is to know about terminal rates. If those are the cases, you have to say that we have reached a top that's going to be in place for many weeks before we get new data that either proves the case that we need to go back down or disproves it, and then we need to go back up. But for the time being, we are done. I really cannot be bearish of anything. This is the 5 year now, and if we have a look at a monthly chart and we go back, I mean, look at this. This is basically pretty ridiculous move. We went from minus 60 to 160 in less than 7 months. I think a period of coming back to these levels, what's that, 118, 118 in yield, that kind of move is warranted. And actually, look at the level in the bunds, 170 met. It slightly went through it. Actually, let's go for a weekly chart so you can see it, and straight back in. To me, this is a sign that we have achieved everything that we're going to achieve, and the sort of the likelier path is one of backing and filling, say between 123 and where we are, 170, something like that. My favorite chart actually is this one. I kept on telling you that the French market is the one that has the best technicals. Absolutely top ticked my line, and to me the likelihood is over the course of the next couple of weeks we come back down to 171. It's what makes the most sense to me, that all the markets have peaked, and that we are now in a trading range for several weeks. I really can't see why we should make new highs in any of them. To me, this is a really important chart at the moment. This is the differential between the bunds and the 10-year note. I was very skeptical at these levels. This is now a monthly chart, so you can go, this goes back all the way to 2012. I was very skeptical of this chart at the 2% level. I thought that this was unsustainable. And really, it's only because the ECB is behind the curve, certainly more behind than the Fed. You can argue that the Fed is behind the curve, but you can't argue that the ECB is any further along than the Fed is. In fact, I would argue that it's, quite a bit behind. What is likely to happen here? You can see that this kind of level is not out of the question, going down towards the 130. To me, it makes perfect sense that the US yields, having reached the objectives, turn first, followed then, if you get confirmation that inflation is under control and so on, by the European yields. That makes fundamental macro sense to me, that the move is likely to be in the US, because we have gone 300 basis points almost in the US, and we've only gone 150, 200 basis points in the EU, in German bonds, and therefore the retrace is more likely to put downward pressure on this chart than it is to give it upward pressure. If we look at where we're basically at the bottom of a trading range which has been there for over a year. Therefore, the pressure is more likely to be on the downside than on the upside. And this is the main reason why I can't really get bearish of the euro. But we shall look at that next. And here we have DXY. It's not a bearish chart. I can't say that it's bearish, but I am very, very weary of it at these levels. Fundamentally speaking, I just can't see the likelihood, if I'm correct in saying that yield differentials are going to be pressured to come in between the euro and the US, then I can't really see a strong move up in DXY. If we we are at higher than we have been since God knows, a long time. And therefore, on a relative value basis, I really can't see what the attraction is going to be in the dollar. Because if we go into a recession, the recession is going to manifest itself everywhere, and really it's just the flight to safety and the yen which are the reason why DXY is not lower. In which case, it doesn't make any sense to trade DXY. It makes far more sense to trade dollar yen, and it doesn't really make much sense to be bearish of the euro. It makes sense to be bearish of the yen. So let's have a look at what those look like. Here we have a weekly chart of the euro. And really, if you count 1, 2, 3, 4, 5, 6, 7, 8, we are very much exactly where we were 8 weeks ago. We haven't really moved, which makes some sense, because in the past 8 weeks, the euro differential on the 10-year against the US has actually gone down about 30, 40 basis points. And therefore, that has been favoring euros. And this is what I keep on saying. Why would you want to be bearish of the euro per se? I think rates there are on the way up. Yeah, I mean, the curve is going to flip, much like in the US. You're going to have another period of consolidation in bond yields, just like in the US. But the pressure to me is going to continue to be on the downside in those yields. Can it back up 10 basis points? Of course it can. But the overall direction of the differential, I think, is going to be going down towards 125 and 100 basis points from the current 156 basis points. And if that is the case, it's very difficult to see that we will just break down in terms of euro and continue lower. Therefore, I just don't, at these levels, I feel very uncomfortable shorting it between 104.30 and 103.40. I feel very, very uncomfortable shorting it because I don't see the reason why the dollar is going to be strong per se, because it's in no one's interest. A very strong dollar sucks the oxygen out of the room and basically makes all risk assets go swoon, basically. And I don't think that is in anyone's interest anymore. I don't think that any central bank wants the dollar to be stronger than it is at the moment. In fact, they would probably like it to be weaker, including the Bank of Japan. The Bank of Japan is, and we all know that basically they kept JGBs at 25 and they said they're going to be there for the rest of eternity. But they're also very worried about the level of the yen, which we will look at next. Okay, so here I've put dollar yen and euro yen next to each other. These are weekly charts. If you have a look at this peak in euro yen back in the early first quarter of 2018, it's the first quarter of 2018 is right here. Okay, so you can see how much the dollar yen has depreciated against how little it's depreciated here in terms of euro yen. This is the 135.13 level, which is the previous high on the monthlies, which happened many years ago. And this is, as you can see, it closed right below it, even though the Bank of Japan did nothing, and even though, it's unlikely that they will do anything in terms of higher rates for a very, very long time. What is most likely to happen? Well, most likely is that we bust through it, there's intervention, we come back down towards 130, 127, allow these lines to catch up, and then go again many weeks from now. So what I'm saying is that really the likelihood is that the yen will not lead us. And if the yen doesn't lead us higher, I'm very, very wary of being long yen at these levels. And if I'm wary of being long yen, I have to be trebly wary of being, other way around. I'm very wary of being long dollars against the yen at these levels. And if I'm, weary of that, then I'm trebly wary of being short euros at 104, 105. That really makes no sense to me. I could be wrong. We could get, for whatever reason, a spike in yields in the US, but I think that is very, very low odds. I think the odds are for lower yields in the States over the course of the next 3, 4, 5 weeks, and that really should begin to deflate the dollar. Or if we go back to the Dixie chart, basically just slow down its pace of ascent. What would be wrong with, go to a daily chart, if we were just to trade between 102 and 104 for an extended period of time? Would that be a weak dollar? No, it definitely wouldn't be. But I just have a very difficult time seeing what is going to make the dollar accelerate at this moment. On to the most boring asset in the world. Well, what can be said that hasn't been said? my bias has to be for slightly higher prices over the course of the next 2 or 3 weeks. Maybe a test of something like, this peak here around 1900. Just to piss everyone off and take out the 1881, get everyone long, and then come back down. What makes sense? What makes fundamental sense? If I'm correct and bonds have basically made their highs and they come down 20, 30, 40 basis points in yields, and the dollar does not scream higher because it's A, afraid of Bank of Japan intervention, and B, the euro differentials against the dollar are going to start coming in slightly or not go up anymore, and we are a very, very important support around that 103, 104 area, then it would make sense that there's very little pressure on gold, relative pressure on gold, and that when we reach levels which make sense, i.e. every time that the market comes down towards 1800, you buy it and you look for something close to 1900. If we enlarge this daily chart, I mean, what more is there to be said about this? For the past several weeks, we've basically been trading 1805 really against 1881. 1881 is a very, very important level. Would the market love to spike it to come back down? Probably. I just can't see this market doing anything, not because I've got recency bias, but because I just don't see what the big motivator is for people to start buying gold now, if they haven't been buying gold for the past 2 or 3 weeks. I just can't see it. On the other hand, around 1800, given the fact that I think bond yields have topped for several weeks and months, it probably makes more sense to buy the dip to sell it back up towards 1881. Dr. Copper has given us a break. It's basically, for the first time in best part of 2 years, broken out of the range that it was in, and 2 years worth of buying is trapped up here. Now, do I think it goes straight down? No, I don't. I think it's much more likely to do something like this, and you can see how oversold it is here. I think it's much more likely for a week or two to stop everyone out either side of this line and then go. Do I think copper prices will be lower in 6 months' time? I don't know, but do I think that this line trades, this 367? I think it's more likely than not to trade over the course of the next few months and then go back up. This is another reason why I'm bullish bonds for the next several weeks, because this is a signal that something is changing. And here we have the gold-copper ratio, which is Gundlach's favorite indicator. It's not mine, but I just look at it, and it broke to new highs since since the beginning of 21. So it anticipated very well the absolute disaster in bonds, and now it's, I guess, anticipating a bit of a recovery in bonds. Certainly what it's saying is to be short of bonds at these levels is silly, and therefore this is double confirmation for me that bonds are going to be probably a better investment over the course of the next few weeks than equities are. But there you have it, very important chart, I think, because simply it stopped going down in October of last year, and that is precisely when bonds really started going berserk on the upside in terms of yield, and this chart is leading them lower now. Just as it led yields higher, it now seems to be leading yields lower. DBC, which is 90% oil or whatever it is, very nasty weekly candle, and really it is doing something like here, isn't it? It is trading sideways with a downward bias, backing and filling, whatever you like to call this. Another sign to me that it's very, very unlikely that we will have acceleration upwards over the course of the next several weeks. So it's all falling to get it, it's all indicating the same things. Bonds have reached their yield targets. The DBC is showing signs of weakness. Whether it's going to be very pronounced or just sideways and not going up is, who knows, but I would not be surprised for it to reach this kind of level, 26.25 or something like that. If you have a look, it's more likely than not to reach that kind of a level, 20, let's call it even 27, which is a 5% move down over the course of several weeks. Why not? This is all pointing in one direction, and that is most probably yields in the US and in Germany, which are 20, 30, 40 basis points lower at the long end, 10s and 30s, than the spike level that we saw last week. 40, 50 basis points maximum from those spike levels is what I would say. And if we have a look at the 30-year bond, it reached 345, 50 from 345. Well, let's call it something like 3%. And have a look at how many times it, 295, looks at how many times it bounced off 295. Do not be surprised to see 295 again. Let's have a look at some asset spreads before we go into the individual indices in risk, just to see what the mood is. This is the mood music. ITOT over government, so the totality of the stock market over the bond market, and you can see what a huge move it had last week, and why I entered the long TLT short SPY trade. It's traded very, very well within levels, and as the likelihood is that we come down towards this 200-week moving average. So the likelihood is that bonds continue to be favored over equities. This is SPY over IEF, so 7 to 10 year duration bonds. It's basically, broken the previous lows here. How far is it likely to go in the immediate term? Around 355, I would have thought, next week, and then a bounce, and then maybe it's down some more. But the important thing to me is that it's turned these moving averages. It's trading below all its moving averages, which basically says be careful. If we have a look at TLT, it's done much the same thing, not quite as bad. But again, it's turning these moving averages for the first time in a very, very long time. For the first time since something like July of last year, and therefore, to me, that gives me that sends me a signal of caution, and also a signal that since bonds have achieved all my targets, whether I'm short of equities against bonds or I'm just long bonds, it is a moot point. But what I'm trying to say is that for the next several weeks, being long of bonds is a much better risk-reward proposition than being short of them. And this is another chart which I think is hugely relevant at the moment. It's NDX over INX, so basically the Nasdaq over the SPX. It's reached its 200-week moving average. And last week, as you can see, this is a weekly chart, it bounced. Another sign that tells me that high beta is going to be all right for the next few weeks. And that can only happen if bond yields are, coming off, i.e. if the bond market is strong. What has happened in this spread? It came back exactly to the level it was at when COVID broke. This is it. This is COVID. For the first couple of weeks, nobody knew what was going on. So NDX being more volatile went down, and then it went, shot straight back up. It tried a couple of times to go higher, failed. And so basically this is this year. So it went from 350 to 15%. 15% give up relative to SPX. And now it's turning. Is it going to go a million miles? Probably not. It's going to go maybe up to here, 315. But that is what, 3%? 4%? So this is yet another chart which is giving me confidence in saying that bonds are going to be good for the next several weeks. On to the indices. This is a monthly chart of INX, and as you can see, it's approaching very, very good monthly support. This is the Bollinger Band, and it's very, very rarely does the market close below its monthly Bollinger Band. Does it close that month below it? The only time it's really happened was in 2008. And then, even then, it rallied back to these moving averages at some stage. So anywhere around the 3,500, 3621, if you get panics, I would buy them. I'm saying that because I'm going to be away for the next couple of weeks, and I just want you to have these levels. To me, what I did is I sold 3-week 3,500 puts. They suit my book because I am short of the market against my long bonds. So this is a bit of a hedge against the short equities side. But I really probably want them down there. There is no way in hell that I can see that the market is going to be lower than 3,500 over the course of the next couple of weeks. I am pretty convinced that now we go pretty much sideways in equities until we get earnings data. Until we get real earnings data, we should go sideways, simply because of the Blue Angel chart, which I can show you again in a second, but also because we have done a hell of a lot. And SPX is more likely to stay under pressure because of what energy is doing, i.e. energy is deflating. And if I'm correct that bond prices are going to be good over the course of the next couple of weeks, then also you get the counter effect that NDX does better, as I showed you in the previous chart. And if NDX does better, being a much larger sector than energy is, you will get the tech side of things pulling SPX up, however much energy tries to deflate it. So I just can't see SPX being kept down, because if I'm correct and bond prices do well, it'll be levitated too. Once again to the Blue Angels, and the reason why I say that we now have to wait for earnings is because I've never seen a chart like this. This is almost impossible. I would have bet money against it happening. We still have earnings expectations rising. You know, how can that be? I have no idea. Either these analysts are complete idiots, or there's something going on which I don't understand. To me, this is just impossible. So what have we done this year once again? We have basically done we've done the multiplier, right? The multiplier, the only difference is the multiplier because of the bond yields. If now the bond yields are going to be decent, i.e. they're going to be well behaved, they're not spiking anymore, then there is absolutely no reason to expect this market to go down anymore, right? Not unless these earnings expectations turn like they did in 2007, 2008. We need to see this. We need to see that downward slope for this market to continue down. And we're not getting it. And that's why I say that, you know, from certain levels like 3,500 to 3,600, it is ridiculous to expect this market to fall without earnings which make these, these expectations turn. That's where I'm at, and I'm not going to change. I just don't think that the market can go down that much, given that what I'm expecting for bond yields. I also wanted to show you this monthly chart of NASDAQ. You know, this has been here for several months. 10,957. I think it missed it by almost nothing. You know, less than 80 points. You can see here that we are actually through the monthly Bollinger Bands or right on top of them. You know, this is another reason why I think we're going to get a bounce over the next couple of weeks to some level like this, 12,100, something like that. Bond yields are done. I think they're done, and I think you get this kind of retracement at least 12,200, 12,100. Why not? Weekly NDX, 200-week moving average, hardly ever breaks it. And here we are. This is the 0.618 retracement of this whole move right down there. You know, 10,000. What is that? 10,700, call it. You know, I just find it very, very difficult to get bearish at these levels. I think risk reward says that at some stage we go back, you know, 12,100, 12,200, the levels I showed you. And everything that I look at, it basically brings me back to one conclusion. Bond yields are going to go down 40, 50 basis points from the spikes of last week. I wanted also to show you European equities, and basically they are retesting the low while SPX went through the low. Where do you sell equities in Europe? I really find it very difficult to sell them down here. Fortunately, I don't have to. But to me, this 36.24 on a weekly level, and this and this 36.45 on the daily level are extremely important and also likely to trade. So 36.45 on a daily level, 36.24, I mean, who cares which? But to me, you sell them at those levels. This also makes me think that there's going to be a bounce in all equities over the course of the next couple of weeks. That they're not going to be as weak as people predict. People are predicting Armageddon. I just don't see it. Not if bond yields behave themselves, and not before earnings show the true shape of the Blue Angels. There is no doubt that on my clean chart we are reaching some very, very important levels. And I wanted you to have them, so to me this 36.45 is pivotal. If we close below it, and the market is respecting it at the moment, if we close below it, we're going to have a sharp spike, and then we'll come back. But the sharp spike could be all the way down to 34.28, 34.29. If we go back to why that is, look at these levels. Look at how quickly we went from one level there to another level, and what air pockets there were once it broke. I mean, it's never broken this level from all the way back from when is that? That's 2020, last quarter of 2020. So it really needs, if it's going to have a good flush down to 3,500, 34.28, those are the levels to really pick it up. I really think that we're going to have a rally all the way back to 4,000 at some stage and then back down, because bond yields, that's all I've got to say to you. If bond yields will not allow it to stay down there, it's very, very unlikely. And I'm looking forward to being a buyer, either through my puts getting exercised or getting a call saying it's trading 34.28, because I really want to buy it at that level. Volatility keeps on being the canary in the coal mine that does not die. It keeps on saying that there is no panic. And that to me is, important. The close above 30.11 is also to me important in volatility, saying that we will probably get another spike towards 35, 36 and then back down. But unless we can really close above these highs, these highs that we've had in 2022, which are it's around 37 and a half. We really need to close there for there to be any panic, and I just can't see it. I just don't see why we would get panic now, having survived the higher yields, having survived everything that the market has thrown at us in terms of war, prices of commodities. In a period of consolidation for all of those, why should we break higher in volatility? And therefore we are more likely at some stage to break back down towards the 23% range, just to get everyone annoyed. Now, don't get me wrong, this is a very clear shape of things to come, i.e. we are still in a bear market and we will continue to be in a bear market. But that doesn't mean that we can't have 300-400 point bounces in SPX. And on to the bias and levels. I still think that we're not going to get massive moves in the yield curve. They're likely to be parallel, but overall we should be pretty stable in the yield curve, with the 5s, 10s and 30s, I hope, having all peaked, and these are the support levels. So you can see how flat the yield curve is likely to be. All the European markets have also achieved all the targets, and over time, over the course of several weeks, they should try and retrace back towards support, and we will try to pick them up again to go for another swing to probably new highs in Europe. I certainly think that Europe is far behind the Fed and therefore needs to do more. These are the levels in all the risk markets. I think that NDX is going to be a better performer than SPX, simply because energy is going to deflate SPX, or is deflating SPX. And if I'm correct that these bonds have all peaked, then NDX will do better. Anyway, all the levels are there. I don't expect much in DXY per se. I expect more volatility in the Japanese yen rather than the dollar, and that is one to watch. Gold, I really can't get bullish until it closes above 1881, and then only for 1905, 1924. I don't think we're going to have a massive move in bonds. We're only going to go back to where we were a couple of weeks ago. So what does that say for gold? Well, not very much. Now, word of caution, I'm away from Tuesday evening. I'm flying to the UK to finally see my son after a long time. So for the next 2 weeks, there's not going to be a video. I will be taking my laptop with me, and I will try and tweet to you whenever I can. Thank you very much indeed, and have a great weekend, and I will tweet you on Monday.